The 1929 crash is often remembered like a sudden clap of thunder, as if everything happened at once. Stocks fell from the sky one morning, and the Great Depression began that very day. Yet history rarely works that way. What happened on Wall Street in October 1929 was not a single bad day or the punishment of a few greedy speculators, but the quiet ending of a 10-year dream built on unchecked optimism, a financial bubble inflated by debt, leverage, and blind faith in endless growth. And when that bubble burst, the world learned a harsh truth. Trust is far more fragile than it seems, and once it disappears, no central bank or politician can restore it overnight. The crash was not one chaotic moment, but a slow process, the result of excesses piling up over years toward an almost inevitable breaking point. And if this sounds like an old story about ticker tapes and fedora hats, it isn't, because today's financial system contains the same ingredients: cheap money, speculative frenzies, inflated asset prices, and a culture that insists markets only go up, making the real lesson of 1929 not how fast everything can be lost, but how easily we convince ourselves that things will always be fine. Set during the Roaring Twenties, a decade of prosperity and technological wonder, America believed in a bright future while beneath the surface farmers drowned in debt, wealth concentrated in few hands, families lacked protection, and banks freely extended risky credit. The stock market became the era's most seductive game, drawing in ordinary people with stories of easy wealth, fueled largely by margin trading, where small sums controlled large positions, working perfectly until prices dipped, margin calls hit, panic selling began, and a system built to collapse under pressure revealed itself. Strikingly, this optimism wasn't limited to the public, but shared by bankers, politicians, and famous economists, because collective euphoria dulls even the sharpest minds. And when everyone is winning, no one wants to ask what happens if it goes wrong. Warning signs were ignored. Credit flooded the system. The peak arrived quietly. Panic spread quickly. And on Black Thursday and Black Tuesday, it wasn't just prices that collapsed, but trust itself. The crash alone didn't cause the Great Depression, rather a fragile banking system and disastrous policy choices turned it into catastrophe as banks failed, savings vanished, credit froze, production collapsed, unemployment soared, and people lost faith in the future. This disaster wasn't inevitable, but human-made, born of poor decisions, weak oversight, and the comforting belief that nothing could go wrong. The Great Depression proved how fragile prosperity is, showing that when systems fail, not only the reckless, but even the cautious suffer because without safety nets, everyone is exposed. Viewed from today, the story is still alive. From the dot-com bubble to the 2008 crisis to cryptomanias. The details change, but the cycle remains the same. Cheap credit, soaring prices, this time is different, and a brutal return to reality, with the most dangerous words spoken not in panic but in calm. Today we see similar conditions with years of low rates, abundant liquidity, massive debt, new narratives, and the same core emotion: trust. And history shows clearly who the system protects when that trust breaks. The true lesson of 1929 is not panic but resilience, not blind optimism but awareness. As those who survived understood cycles and knew nothing lasts forever, forcing every reader to confront a simple question: if things truly go wrong, am I prepared, relying on knowledge, or merely hoping, because history may not repeat itself, but it rhymes through greed, fear, denial, and collapse, making 1929 not a lesson trapped in the past, but a mirror held up to the present, with a conclusion that is simple and uncomfortable. Do not worship markets. Do not confuse speculation with wealth. Hold on to knowledge, balance, and caution, because sometimes things do go wrong, and usually no one is ready.